The Moving Iron Podcast is brought to you by these great sponsors. Are you looking to value your equipment more accurately, target the right buyers and close more deals, reach your ideal customer? Then look no further. Fusible isn't just about ag data, it's about action. Our best-in-class solution empowers you to value your equipment accurately, make informed decisions, and find the perfect prospects. Ignite your dealership's growth at fusible.com/movingiron-podcast. Out in the field, every decision counts. You wouldn't plant without testing your soil, so why would you prospect blind? Introducing EDA, your one-stop shop for ag equipment intel. EDA goes beyond specs and prices. You get deep dive data on every piece of equipment like UCC filings that help track ownership changes and uncover potential sales leads. D&B firmographics, which help you understand the financial health and buying power of potential customers. Market trends that help you stay ahead of the curve, and insights on equipment demands and pricings. With EDA, you're not just looking at data, you're seeing opportunity. You find the right buyer, sell smarter, and build lasting relationships. Visit edadata.com for your free demo and unlock the power of knowledge. For over 80 years, Iron Solutions has been your go-to data source for ag dealers, lenders, and manufacturers. Get powerful appraisal and value forecasting tools that fuel profitable decisions anytime, anywhere. Get your free demo at ironsolutions.com. Iron Solutions, confidence in every click. Today, there are many ways to finance ag equipment, but nobody delivers simple, fast, or flexible financing like AgDirect. Learn more about your options to buy, lease, and refinance equipment at agdirect.com. Valley Transportation has been hauling ag and construction equipment across the country for the past 33 years. Call Parker at 800-657-4910 for all your trucking needs. At Valley Transportation, our goal is to help you reach yours.
When you partner with Axon, you immediately gain access to a full range of products and solutions designed to meet the complex needs of today's grower. We carry all major brands and sizes of tires and wheels. We specialize in large diameter wheels for large equipment. We have one of the largest OEM replacement wheel inventories in North America. Known for extreme flotation setups, duals, and triples, we have wheels for all makes and models of tractors, sprayers, combines, and grain carts. If we don't have the wheel in stock, we'll custom build, sandblast, and paint in-house. There isn't a more vast inventory in North America dedicated to helping dealers move more iron. With facilities on the West Coast and in the heart of the Midwest, leverage our 230,000 square feet of indoor inventory to solve any problem a grower may have. Move more iron with Axon.
Moving iron in the 21st century. Hard-working people working hard for you and me. Moving iron time and time again. Through the years you'll find us here. Moving iron.
Hello and welcome to Moving Iron Podcast. I got Rich Posso back here to talk about what's going on in the world of economics and markets and business and all that fun stuff there. Rich has got a really good podcast out there called Critical Point, and he does that and gets out a lot of good information. But Rich, how you doing, bud?
Good, thank you.
Good. Rich has come fresh off the Moving Iron Summit there. He's gave a couple great presentations, got a lot of good feedback about that. So if you're interested in getting Rich to come talk to your group about what's going on in the marketplace, you should reach out to him. And Rich, if folks wanted to do that, what's the best way they could do that?
Contact me at rich@ag-financial.com.
Right on. All right, talk a little bit about your podcast, because it's all about what's going on in the world of business and understanding business cycles and those kind of things. And obviously, right now we're switching to a different business cycle. It feels like just because of now we know who the president is, so we can start making those plans. So, talk a little bit about your podcast, where they can find it.
So the podcast, you can go to criticalpointpod.com. There's also another website that'll take you more directly to the free and locked up videos, audios, and that's criticalpoint.podbean.com. So go there, and then you can also go to Rich_Posson under Twitter or X. The podcast puts out morning briefs every morning. But for those who are interested in the larger moves and it gets a little redundant and too time consuming, I do a weekly update. And people like that because at the beginning I try to give a snapshot and then I go into greater detail and spend longer. And the point is some people can watch or listen for a little while and then they wait and finish it up over the weekend, that kind of thing, and fills them in. My modeling provides an insight of how's the markets going up and down during the month, during the week, even whether or not we have an up-down day. But I don't give alerts anymore on those things. What I'm really focused on is the larger trends during the year, during a decade, for a decade, and we give alerts on those. I put my money where my mouth is. I trade and invest myself, and I put those alerts out saying this is what's going to happen for the next 30 days to maybe 5 years or something like that. And it's based on primarily the stock market, the grain markets, but I also have gold, Bitcoin, crude oil, and definitely the economy. I'm really into using these business cycles in the economy as well. And the neat thing with these business cycles, it's just a repetitive pattern, but I've learned how to discover many different patterns to create like a clock to give us an idea where certain fundamentals and types of news are going. When's the bad days coming? That's what I'm more interested in anything because profits seem to take care of themselves. But losses, that needs some management. Okay? So I want to know when the bad days are coming. And we can kind of do this like once a month. There's going to be something bad coming a couple times a year. But I even have a once-a-decade sell signal in the stock market and the economy when we have had a recession every time for the history of this country. And some of them get far more important because of super cycles, which I'm not quite the fan I used to be of, but we monitor those as well. Those are patterns that might take 100 years or something like that. So, they should take a look at it, sign up. My guess is it'll only take them about 30 days, and they're going to want to stay with me for the rest of the decade because it's going to be a heck of a story. Yeah. And we want to make money out of it and manage our risk and do good business and take care of our careers.
Yep. And you've talked about that quite a bit on here, that this run that we see now is going to be good up until about 2030, and then we've got some issues that we need to take care of at that point. But we'll worry about that in 5 or 6 years from now. So we'll jump on that train. All right. So we've had a few things happen since you were on last. We obviously had the presidential election. President Trump was reelected to another term of being president. Saw the market take off and run. You saw some really big moves there. Some of this, I think, maybe some of that is Trump, and some of it is, hey, now we know what gear we can get into and what field we're playing on, and so we can start making those plans and start moving forward. You saw a lot of movement in the markets based around companies like Bitcoin, for example, is a good one of those, where the movement in Bitcoin was the anticipation of less regulation when it came to some of those things. A lot of the movement we saw in a lot of companies was based around the fact of some deregulation that we might see coming down the pike. I guess, Rich, as you look at this, your thoughts on what we saw from that the morning after that the Trump won presidency, and where do you think, from a business perspective and looking at your models and those kind of things, how does that set the table from maybe something you thought different going into 2025 before the election?
Yeah. So for a few years now, I've said really we'll see 2025 as a good year. We're going to see it perhaps last into 26 and maybe a little bit of a problem. Then still higher, 28 into 2030, something like that, before we get to the serious problem. And that hasn't changed. But under Trump, I kind of view it this way. Under Harris, I'd have about 5 to 10 things I got to think about and watch. Under Trump, I got about 20 to 100. So it just makes it more complicated. Doesn't mean it isn't going to be a good time. It's just we got to look over our shoulder and expect the market to get a little scared from time to time, a little more fluctuation. I do think there's a possibility of not being such a good year, but I can see how it could be a great year too. And I am speaking of 2025. So I think we just have to watch. I mean, if the tariffs really come in and hit heavy, I think you're going to see an immediate trade type war that's about as bad as you could think of a World War III, other than the bombs won't be flying. I mean, it could be that ugly when we're going to wake up. We're just not selling stuff. We're not shipping anything. And my guess is they won't let it go that extreme. Okay. And there's already some people saying even under heavy tariffs, there could be a period of it's actually quite good. It was under President McKinley for about 2 years. And then the tariffs didn't work for him. And Herbert Hoover had some success, but in his last term, when he went into tariffs, it basically helped create the 1929 crash and depression. So tariffs, they can be a good thing for individual industries, products, but when you do it across the board and run your nation that way, history shows even if it's good in the beginning, it does not end well. Never has. And the government never makes the amount of money you might think from that. And Trump's hopeful he makes so much he actually cuts our income tax or even wipes out our income tax. And it's very difficult to see how the math does it. So to me, the biggest concern, the risk for me of how I invest and trade and manage is those tariffs. Without that, most of it's really just trying to cut government expenses is how I look at it. And it's really still can be a pro-business thing. And I think stock market can just go sky high, okay? But you throw those tariffs in, suddenly you might have a down market, not up. And it's tricky on the commodities. Same story. Commodities ought to be working up on their own over the next year or two, just from normal economics. But you throw in the tariffs, they may explode, but also crash afterwards. And you may even see if the world does respond to those tariffs so quickly, we don't even get a chance for the explosion that suddenly these commodities say, wait a minute, what happened here? They're just not working for us. So it's just many different paths to take that we have to watch, but it's not like a hopeless situation where we say, oh, well, boy, this is going to be a difficult year to forecast. I think the model is going to do fine keeping up with the markets. It's really just a matter of how much do we make, we may not make as much as we could have under somebody else, okay? Or maybe we make more. That's how I'm approaching, again, not so concerned where I'm going for the profits. I just want to make sure I hang on my money. And,
right.
So I'm rather optimistic here. I feel like, well, we have to be, okay, because we're going down this path anyways. And there is going to be some interesting things going on. It will be interesting to see how they cut in government. I mean, I'm a fan of cutting government somewhat. I'm not a fan of cutting a lot because it probably is going to go into austerity and throw the country in a recession. So we'll see how far they go with it. But I can be optimistic next year for the stock market and the U.S. economy. I don't see a great GDP, but it's just not going to be, right at the moment, it's not going to be bad. And I'd like to remind everybody in 2017, when the markets were shocked that Trump got elected, actually stock market did very well. Under presidents, if you want to rank them that way, Trump enjoyed one of the better stock markets of all Republicans, except for President Hoover. So let's be optimistic and see what we can make with it and deal with it the best we can.
Right. All right. So I'm going to throw this out. You talk about regulation, what that looked, and I asked that question earlier. Over the night, you saw the Department of Government Efficiency, I think is what it's called, pop up. So you got Elon Musk and you got Vivek Ramaswamy. I think I said this, I probably butchered his name, but nonetheless, their primary focus is to go in and start looking at regulations, government, just how government works and what's going on, bureaucracy, yada yada yada. In your view, you kind of saw something like this. I mean, Reagan did something similar to this, where he kind of tried to do some stuff. Clinton tried to do some stuff with this when he went to try to balance the budget and those kind of things. Both of those times we saw some. I mean, obviously Reagan was fighting huge inflation during his presidency. Yeah. A lot of that stuff kind of spilled over into the 90s, and you saw that a lot of presidencies take off and run during the 90s where they had some booming economies. But it seemed like when they were trying to cut back on regulation and trying to cut back on the overall just bureaucracy that is the government, it seemed like the government or the stock market reacted to that. I guess, what are your thoughts about this, and how do you think the market's going to react to this? Assuming that they just go.
It depends how hard and fast they work it at, because I think they're going to learn they can only cut some regulations. They can only clean up the government and make it a little smoother running. If they're going there with the ideas that it's going to be a totally different government, we're going to have some problems in the stock market. Okay. That doesn't mean we'll have problems in the economy. It just depends how long it takes to trickle through, but the stock market will react quickly. Okay.
Right.
So to me, it just depends how aggressive they are. When I heard of that department they're going to start, I thought, it's been a long time. Let's take another shot at it. But I just, you look at Elon Musk, he's one of those people that can be very aggressive and move. And I just hope they don't go through way too fast and start making a lot of mistakes and just frustrate everybody.
Yep.
But so for the moment, on a conceptual basis, I would say it's a good thing. And let's see where we go with it. But again, I don't want to see them move aggressive here and try to change the country overnight. I think that's going to give us some of these scares along the way in the stock market, and we'll probably learn they're only scares, and the market will go right back up again because the market, it gets worried over policy change and might drop quickly. Then it realizes, but if you change that, it may be 6 months to 2 or 3 years before we see it hitting the economy. So if you look at where we are today in the economy, it's really good, okay? So the stock market is thinking, well, if I stay just with business, I'm going higher, okay? And it's just a matter of all this other stuff comes in that, it might be noise, it might be fluff, who knows? But I think the stock market, part of the reason that it's holding these gains right now is it's rather optimistic that things will be all right and we'll make some changes that are worthwhile.
All right, so let's talk a little bit about what the Fed did at the end of the Fed meeting back in October. They did go ahead and cut, or I guess that wasn't October, that was in November. The last week, I guess, they cut interest rates by 1/4 point. You talked about that last time we did this. You thought maybe that was a possibility. You felt like that was a good move for the time being, but at the same time, you'd understand why if they decided to wait and see one more thing. Looking at what we see right now, Rich, I mean, they made it pretty clear that in the September meeting that they were going to cut a 0.5 point and then we're done. We're done for the rest of the year. We're not going to do anything else. We'll take a look back in January. Well, here we are, 1 month, almost a month later, and they're saying like, we'll go ahead and hit another quarter. Do you feel like the December meeting might bring another quarter into the mix, or do you feel like we're probably February, March timeframe before we see any other kind of movement in the market?
For the November meeting, my model was saying they should cut a 1/4 point. So I said, well, if I was the Fed, I'd cut a 1/4 point. But then I asked myself, but I'm not the Fed. Are they really going to do it? At the last minute, I said, I don't think they'll do it. There's just too much noise here. They'll just wait a bit. And they cut it. So, I wasn't right for my personal opinion, but I was right. The modeling was saying that they probably should. And I think they did the right thing. I like it. But not only that, because I think they were kind of sending a message to the bond market that's been raising rates while the Fed lowered the prior time. They started raising rates as soon as the Fed cut a 0.5 point. And I'm sure the Fed's scratching and saying, what are you people doing? Well, a lot of it was the Treasury, U.S. Treasury started their fiscal year in October. And it's like they just come in and bang, they did a whole bunch of, got to roll debt. We got to create new debt. And Wall Street had to swallow that, the banking system, and sell it to somebody, right? And so they just raised rates saying, hey, that's how you normally do it. It's a supply demand thing. So they raised the rates. Then as it comes close to election, however, you got speculators in there. You got risk managers in there saying, boy, if Trump raises tariffs, we're going to have super high inflation. We're going to have super high interest rates. It's going to be a mess. And the bond market's probably pro-Trump, but they were just saying it's still going to be a mess. All right. And so they drove the rates even higher still. Right today, this morning, it looks like the rates are kind of calming down a little bit. But I wonder if the Fed didn't throw that 1/4 point out there saying, hey, let's not push these things too high and cause some problems here. I noticed on the overnight rates, they've been advertising. I don't know how much the banks have used them because banks kind of hate to use overnight rates provided by the Fed because it can raise an issue of the Fed member is a regulator as well as an interest rate controller. So if you lower rates to the banks to help them on their books, pretty soon someone from the regulatory side of Fed might be calling you at your trade desk and saying, oh, IG, you took some of our overnight stuff here and we gave you a nice rate, but is everything okay at your shop? And so, people get nervous. Well, I don't really want to talk to the regulator. So some of these banks don't really use the rates as much as the Federal Reserve law. There's some discussion on that whole side of the industry of saying, how do we make this user user-friendly and make these banks feel more comfortable doing it. So that tells me the Fed was concerned of some sloppiness and slippery stuff going into election as well as into the end of the year. And it normally is slippery as they polish off a year of banking. It's just the mechanics. But the election added to it. So I think they did a little safety stuff there, which makes me wonder now they might not cut in December. And I'm probably going to be wrong again because my model's saying, yeah, they ought to do another quarter point. So, right. I mean, at one hand, I want to see it because it probably should help the stock market and help the economy,
Yep.
But I wouldn't be surprised if they don't. And so shouldn't even be gambling on it. Just wait for it to happen and see what it does. But, I can understand another quarter point because I think they're getting closer to what's called the Taylor rule, that when they were above 5%, it was saying by summer they should have already been down to 4%. Right. So they're running months behind. And that scared everybody that, if they wait too long, the economy, yes, it's backing off and we want it to cool the inflation, but we don't want it backing off to where it gets away from us. It's like they were scared of going one way. Now they're scared of going the other way. And it's right. And I've always said for the Fed, it's like damned if you do and damned if you don't. It's a very, very tricky job.
Right. Yeah.
So at any rate, I certainly won't be surprised if they lower a quarter point, but I'm kind of feeling like I don't know if they have to because they could probably do it in the next meeting in early 2025 and that sort of thing. And again, when I look at just economy by itself, I don't have and inflation, I don't have a problem lowering rate when I look at where we are today, but I'm going to jump into inflation now because I've done some interesting things here with subscribers, and I even spoke of it at the summit. We are due for higher inflation in 2025, no matter who's in the White House. It's just the mechanics. It's business. I don't think it would go up much. But the interesting thing is it should go up into 2026 to maybe even 2027. That's long enough. It could go up quite a bit. And then I'm thinking if Trump does the tariffs, we may see a surge of inflation. We may even see the people that have been complaining or worried, might be a better statement, that we're reliving the 1970s when inflation was up early. Then it came down about mid-decade. And then it went right back up late decade. And then when you looked at the total decade, it was one of the worst we had seen in many decades. And there are people nervous of that. And those tariffs are the key. I can see if Trump does just some of that tariff stuff, he can just squeeze by and not ignite that inflation. And I think he can kind of lean on the businesses a little bit to make sure they're not gouging, say, hey, be pro-American. Don't gouge people. He could get away with that probably more than anybody. But I think the risk is if he really goes gung-ho with these tariffs, we're probably going to see higher inflation before we can rebalance it with increasing manufacturing, because we really are trying to bring those jobs back. Biden was trying to bring them back, and we're building facilities now, but it takes time to crank those things up. And so I'm concerned if that inflation explodes, you won't explode the domestic production here.
Right.
And then that inflation stays a little too high for a little too long. And the Federal Reserve, I realize Trump might be able to lean on them, but really they have no choice if it's moving higher. I mean, in my book, if it goes back to 5.5, I'm there. I'm going to slam those rates overnight. It's going to shock you, So we'll see. We're flirting with 2.6% inflation this morning, CPI, and it did tick up from September. And I'm looking for a bottom inflation September on into first quarter of next year. So I got all excited and told my subscribers this morning, we might as well call that a bottom, but really you can barely see it ticked up. So I'm also warning them that may not be so clever right now. We need to watch things for a while longer. It could tick back down by early next year and then up for the rest of next year. So I'm not aggressive on this idea of rising inflation right now. But I'm convinced under normal business it would tick up some. And now the question is, are we going to add something to that and make it worse? Okay. And by the way, if they start doing all this tariff stuff, I mean, China's still struggling. They're doing yet another stimulus, I believe, if I've got the numbers correct here. But they still have their real estate issue. Their economy's been dragging for a while. And I think to me, you escalate the trade war. You may hurt their economy, and I realize Trump might say, well, I don't care, because the idea is we're supposed to be bringing jobs back. But the point is, that can be a contagion, at least for other countries that might not be doing as well as we are right now. We could survive China having a real problem, and it might not even hardly make a dent in our markets. But you just don't know how severe something like that would get. Okay.
Right.
And we also have to think of the Japan carry trade. You start slamming these interest rates higher. I think the carry trade and the currency side and debt side, they've kind of worked their way around where they're a little better protected. They understand this stuff can happen because it did happen in July, August. They had their almost equivalent of what we had in 1987. That happened to us, and the stock market dropped 30-some%, nothing flat. Well, in Japan, it did about the same thing. But I'm hopeful Japan is stabilized and moving forward. But again, this whole tariffs thing, I'm trying to think what else can really cause a problem. But right at the moment, it looks like the tariffs thing is about the only thing that would give us something to really worry about in terms of the stock market, commodity markets, economy. So.
Okay, so let's talk a little bit about the dollar. So you saw dollar spike up, right? Obviously, like everything else did. It's kind of settled back down. We've seen a little bit of overnight weakness in the dollar, but for the most part, the dollar staying fairly strong comparatively to what's at the usual suspects. Up against the British pound, and you're up against like the euro and those kind of things. We're still seeing some downward pressure there. But as you look at all the other currencies, the U.S. dollar still is fairly strong. As you look at that, and we look at where commodity prices are right now, you start looking at grains, and you start to see the movement that we've seen there over the last about week and a half or so. There's got to be some level of pressure that we're going to see. We're seeing some selling off here. We're seeing some profit taking, those kind of things. But as you look at that, assuming that the dollar does continue to grow in strength, and we see there issues that we're seeing in Brazil with growing down there. As you look at the grain markets, what are your thoughts?
Yeah, probably about 7 years ago, I started changing my thinking on the dollar impacting grains. Came up with the idea it really doesn't impact as much as everybody thinks. But at least today, I am getting concerned the dollar moving straight up like it has is starting to strike a nerve with some of these global traders. And if I believe the dollar ought to back off, when I look out over the next 4 weeks, it ought to back off for a little while. But I'm now a little concerned it might actually be higher by January, however. And I'm thinking interest rates are going to do the same thing, that they can back off in the next few weeks, but can be higher in January. Whereas a few months ago, I said you probably wouldn't see it stay up that long. And now I'm concerned these markets are concerned. Where is the U.S. going with all this political stuff that's going to convert into policy, that's going to convert into how do we do business, how do we live our lives, and does that trickle in the world? So a lot of ifs there, but they know they have to study this and question some of this stuff. So I'm thinking if the dollar wants to, even if it backs off next few weeks, if it's higher by January, I think that can clip us a little bit on our exports. I don't want to get too scared of that because it's still not the connection, the importance that it used to be, but it's getting sensitive. Probably more for wheat, which is why wheat's off here at the moment, partially. There's other factors. And granted, really, grain should be moving higher into summer months just from normal seasonal demand. But again, you have this worry, where are we going with world trade? Is the tariffs going to explode grain prices and then maybe drop them hard because we lost the business? Or are we just going to lose the business right off the bat and have lower prices? So the dollar, my modeling is watching the dollar a little closer than what I did, say, 6 months ago or even a year ago. And I am a little concerned that we're going to have some strength in the January in the dollar and probably even firm to sideways to even up a bit more in interest rates in January. And that makes me a little concerned that the stock market will be down about December, January. But the interesting thing is the model's trying to hold out for a little higher in the stock market into December. Then we'll look for that sell-off here. So, and it is reaching some long-term targets ahead in the stock market, so we can back things off. And again, well, I'll have to be a little more flexible. I've kind of had an easy run here, I think, for 2 or 3 years, even though you look at the news and the way the stock market fluctuated, it doesn't look easy, but really the model made it easy. And now we got to pay a little more attention here. We're shifting gears, and we might have to backpedal a little bit before moving forward. But yeah, that's the best forecast as of this morning. The dollar can be higher in January, and I don't think that's going to help us that much. So it may make us nervous.
Right on. Okay. All right. Last thing here, Rich. I want your thoughts on where we're headed. All right. So two completely different. Although Biden did open it up here at the end, but end of his over the last year or so, kind of eased some of those drilling regulations. But as you look at what Trump wants to do and what he did when he was president last time, he really opened up drilling, and the United States for the first time became energy independent and didn't really care what OPEC had to say. We were a net exporter of oil, for that matter, natural gas especially. A lot of natural gas coming out of the United States. So I want your opinion of this as you take a look what's going on in the oil market. You saw what Trump did the first time. You see what he's doubling down on that as far as what drilling looks like, natural gas production, those kind of things. Europe, for the most part, has said, hey, we'd kind of like to get some more of that natural gas from the United States now all of a sudden. So I guess as you look at energy, how do you think that's going to change the world's kind of, you start looking at Brent crude and those kind of things. How do you feel like that's going to start changing what the overall face of oil looks like, right? It kind of felt like when Trump was president last time, OPEC was really they wanted to up production as much as they could. It felt like when Biden was president, they kind of laid off of that, and they were kind of happy with that. It feels like anyway, between $70 and $75 oil. That's really what it felt like from a comfortable standpoint. I guess as you look at this now moving forward, what are your thoughts there? Do you feel like we're going to see more of what we saw last time, or do you anticipate maybe there's hey, we're going to work together here and try to do something different than we've done in the past?
Yeah, good question. I mean, if we do the drill, baby, drill, I think Saudi Arabia's got to consider $10 lower for their average price. I have a long-term range right around that $65 area that I'm going to use for many years until we get to the end of the decade when, maybe it can drop to 30, but that'll be because of a recession. Won't really have anything to do with oil itself. So to me, I think it got that right, and I think Saudi Arabia wants to try to stay above that, so that's why they were hoping for 75. I think they're going to have to conclude that indeed we pump more oil. They got to come down whether they like it or not, but they'll do their best to put the brakes on, and I think they can adjust to it, and I think they'll say, hey, if 65 is the lowest, we ought to be happy where we're going, right. Okay?
Yeah.
And that can also be a minor input to help hold back inflation. And I'm sure Trump's thinking that, but the problem is inflation is a lot more complicated than that. So oil really can't drive inflation down by itself. It would have to be already high priced and inflation very high. And so I doubt it'll really make that big of an impact. But it also makes people feel better at the pump, though,
Right.
So it's just, and a lot of this economics, it's amazing. It boils down to how happy we feel, not necessarily what are we doing with this stuff, And so, on one hand, I think it's a positive for the U.S. and the economy. I don't think we necessarily have to do it because I'm more interested in the other types of energies these days. I mean, I'm putting in solar panels here this week. But you can see how you bring the oil lower. It also curbs some of those businesses, perhaps. But really, I think Saudi Arabia, my guess is they're probably preparing to say, you know what, we may have to sell this as much as $10 lower. But then I'm sure they're also saying, now, let's draw the line in the sand. Can we afford to cut, And as I look at some of these conglomerates or these gigantic oil companies, even here in the U.S., I'm not so sure they want more than a $10 a barrel drop. So I think you're almost going to see like kind of cartel kind of thing go around the world saying, well, we're just not going to let it drop more than that. You're going to pay that. And as long as the economy's good, they'll probably say, well, we have a right to try to make a profit here. And they may try to work along better. I'm very convinced they'll try to work along better for it. But I'm just saying, I can allow another $10 drop off the increase of production. I don't have a clue just how quickly, though, we could ramp up that production, how long it takes to really get in the pipeline. That's not something I study all that often. But again, sometimes talk is far more important than the actual action. So especially to free markets like oil and stock market, okay, they just start dialing in. They shoot first, ask questions later. And So, but I think we're kind of limited right at the moment. I'll allow maybe $10 lower, but around that 65, which that may not be a full 10 right now, but I got a feeling something will step in there and kind of create a floor price, even if we can increase the supply. And the interesting thing is, oil should seasonally start bottoming out now into early next year and work higher into the summer driving season. And I got a long-term business cycle saying it ought to be up next year and perhaps into 2026, which also kind of coincides with many other commodities and perhaps inflation. But if you look at the supply where we are, and now if you do the drill, baby, drill again, I think, that has to limit the upside. So Here we're setting up for a situation when oil should be really cheap. And Saudi Arabia said, darn, it shouldn't go any lower than this. Well, even if that floor holds, I don't think we as consumers have to worry too much that a big up move's coming. You'd have to disrupt that supply in a significant manner to do that. So to me, it's a win situation for we consumers, but it could have other negative consequences in the overall economy too, but subtle. I think more the average American would say, hey, I don't care if it keeps going to zero. Right?
Yeah.
So I'm sure there's a lot of Americans actually happy to hear that of what the U.S. Can do, but I got a feeling you'll see Saudi Arabia and the U.S. companies and European companies saying, hey, there's going to be a floor price, and if we just have to set on oil, we set on oil. So.
Yeah. Okay. All right, Rich, good stuff there, bud. Folks want to reach out to you and get more information about what you're doing. What's the easiest way to do that?
Yeah, content being at rich@ag-financial.com. Ask me questions, give me opinions. I'll do my best to update you. Don't get any heavy sales from me. That's one of my flaws. But I'm willing to discuss things with you. You can also go to rich_Posson on X. I also use that on Threads, but I haven't gotten a good enough habit to keep following Threads the way I'd like. Mm-hmm. At any rate, also go to my website, criticalpointpod.com, and also criticalpoint.podbean.com.
Right on. And that's where they can find the podcast too, right?
Yes.
Okay. Same place too. So check all that out. Take in Rich's stuff. Go to Apple. I know it's on Apple because I find it there, but he does put out a free version of that podcast. Good stuff. Quick hitters, anywhere between 5 to 15 minutes, just depending on how crazy you want to go, Rich. But there's a good floor there to get a good understanding of what Rich's stuff looks like. And then on the backside of that, he has a pay site as well that gives even more in-depth stuff, video version of that, where you can see charts and whatnot and how his model's working. So well worth your time to check that out. Miss anything there, Rich, you want to add to that?
No, I think that wraps it up.
Okay, man. Well, Rich, appreciate you being on the podcast, man. We'll catch you next time.
Thank you very much.
Right on. I'm Casey Seymour with Moving Iron Podcast. Check me on Facebook, X, and Instagram. I keep saying Twitter. I got to say X. Hit me up there at Moving Iron LLC. Go to the LinkedIn at Moving Iron Podcast. Check out the video version of this at the YouTube channel, which is the Moving Iron Podcast YouTube channel. And you can also see me on TikTok at Moving Iron Podcast. I guess we're done talking about TikTok, right, Rich? That's not an issue anymore. Okay, so we're done there. Done talking about that, but go to movingironllc.com for everything Moving Iron related. So with that, I am Casey Seymour with Rich Posson. Let's move some iron, folks. Out. The Moving Iron Podcast is brought to you by these great sponsors. Are you looking to value your equipment more accurately, target the right buyers and close more deals, reach your ideal customer? Then look no further. Fusible isn't just about ag data, it's about action. Our best-in-class solution empowers you to value your equipment accurately, make informed decisions, and find the perfect prospects. Ignite your dealership's growth at fusible.com/movingiron-podcast. Out in the field, every decision counts. You wouldn't plant without testing your soil, so why would you prospect blind? Introducing EDA, your one-stop shop for ag equipment intel. EDA goes beyond specs and prices. You get deep dive data on every piece of equipment like UCC filings that help track ownership changes and uncover potential sales leads. D&B firmographics, which help you understand the financial health and buying power of potential customers. Market trends that help you stay ahead of the curve and insights on equipment demands and pricings. With EDA, you're not just looking at data, you're seeing opportunity. Find the right buyer, sell smarter, and build lasting relationships. Visit edadata.com for your free demo and unlock the power of knowledge. For over 80 years, Iron Solutions has been your go-to data source for ag dealers, lenders, and manufacturers. Get powerful appraisal and value forecasting tools that fuel profitable decisions anytime, anywhere. Get your free demo at ironsolutions.com. Iron Solutions, confidence in every click. Today, there are many ways to finance ag equipment, but nobody delivers simple, fast, or flexible financing like AgDirect. Learn more about your options to buy, lease, and refinance equipment at agdirect.com. Valley Transportation has been hauling ag and construction equipment across the country for the past 33 years. Call Parker at 800-657-4910 for all your trucking needs. At Valley Transportation, our goal is to help you reach yours.
When you partner with Axon, you immediately gain access to a full range of products and solutions designed to meet the complex needs of today's grower. We carry all major brands and sizes of tires and wheels. We specialize in large diameter wheels for large equipment. We have one of the largest OEM replacement wheel inventories in North America. Known for extreme flotation setups, duals, and triples, we have wheels for all makes and models of tractors, sprayers, combines, and grain carts. If we don't have the wheel in stock, we'll custom build, sandblast, and paint in-house. There isn't a more vast inventory in North America dedicated to helping dealers move more iron. With facilities on the West Coast and in the heart of the Midwest, leverage our 230,000 square feet of indoor inventory to solve any problem a grower may have. Move more iron with Axon.